Today we have to start a new topic, right? So I was talking about yesterday is about cost of, we are talking about ratio analysis. So yesterday we have done cost of capital and capital structure, right? So we'll look for ratio analysis now. So this is also very important topic. A lot of times you get uh, numerical questions or practical questions based on the ratio analysis. Okay, so that's why you should know the formulas here. So here we have a lot of formulas. So have you studied module A and B of this AFM? So what exactly we do in ratio analysis? So basically here it's a ratio analysis, a tool of analysis and interpretation. Okay, ratio analysis is a tool and analysis of interpretation of financial statements. So how financial statements we can analyze and interpret. So why we are analyzing and why we are interpreting? To find out the financial position or the stability of the company, right? So either we try to find out the profitability position of the company or solvency of the company, that whether we are able to pay our debts or not. Okay. So that we can find out with the help of ratio analysis. So altogether, I can say that it will tell about the success or failure of a company. Okay. So we have different types of ratios. So we have different types of ratios. So first ratio, what we are talking about is liquidity ratio. Okay. Still people are joining. Okay, fine. So first we have liquidity ratios. Okay. So here we have different types of ratios. So like we have liquidity ratio, profitability ratio, right? So first we'll talk, the ratio is called as liquidity ratio. So in finance, you know what we call as liquid. You know what we call as liquid? Yes, which can be easily converted into cash. That is the liquid. Or if I say liquid funds means which can be easily converted into cash. So here we have to find out that this liquidity ratio, we have different types of ratio. So what exactly we try to find out under liquidity ratio? We try to find out that whether we are able to pay our short-term solvency, means short-term requirements, short-term debts, short-term solvency. We can check with the help of liquidity ratios. Okay. So we are trying to find out that whether we are able to meet our current liabilities or not. Okay. Now, if you have studied balance sheet, so do you remember what is current asset and what is current liability? So what we call as current asset, normally asset we say means which increases your wealth. Asset means which increases your wealth. So when we say current asset means we are trying to find out that currently in short period, in short term, what assets we are having which can be easily converted into cash. Okay, which can be easily converted into cash. So that is called as current asset. Similarly, we have current liabilities. So when we say liability means it's a burden, right? You have to pay. So when I say current liability means you have to see that which all burden or which all short-term liabilities you are having. Okay, which we have to pay. So what can be your short-term liabilities? It can be bills payable. Yeah, it can be creditors, means suppliers, right? Suppliers has given you the raw materials or maybe resources and you have to pay them back, right? Income tax, which you have to pay, dividend. So these all are, you have to pay within 1 year of period, right? So if we say currently means we are talking about short term means we are talking about 1 year of period, right? So which you have to pay. So I'll just share you the items which comes under current asset and current liabilities. Okay, so in case if you don't know that which item we have to take under current assets and which item we have to take under current liabilities, that you can find out. So under liquidity ratio, first ratio is called as current ratio. Okay, so this tells you that whether you are able to meet your short-term obligations or not, or whether you are able to meet your pay your current liabilities or not. So that is called as current ratio. So how we calculate our current ratio? The formula is current asset divided by current liabilities. Okay. So just now I have shared you one page. I hope you have received it. Have you received in WhatsApp group? I'll show on my screen as well. So if you see the page which I have shared, so here they have given current ratio formula they have written, and they have written what comes under current asset, what comes under current liabilities. So under current assets, you have cash in hand, readily market securities, bills receivable, means which you receive from the customers, debtors, stock in trade, prepaid expenses. Okay. Any other current asset which is within 1 year of period or 1 year of time, that comes under current assets. Similarly, current liabilities means sundry creditors or creditors, bills payable, bank overdraft, income tax, dividend payable, outstanding expenses, provision for taxation, unclaimed dividend. So these all are your current liabilities. So we have to find out ratio of these two. Your current ratio should be 2:1. Means always your current asset should be higher. Then only you can meet your current liabilities. You can pay for your current burdens, isn't it? Correct? So let's see one example. So I have shared one example. If you look this question. Okay. So they have given liabilities and assets. So we have to first find out current ratio. Quick ratio, I'll tell later. So current ratio means current asset by current liabilities. So can you tell which all items will take from the asset? And remember, short-term investment is current asset. Name is there, no short-term. So that is current asset. If just investment they have mentioned or long-term investment means then you don't take. So can you tell which all items we will be taking? So short-term investment, stock in trade, debtors, prepaid expenses, cash in hand. So this all you are going to take for current assets. So add all, how much you are getting? Check here, investors plus stock plus debtors plus prepaid expenses plus cash. 1,30,000. Similarly, current liabilities, what all you will take? Equity capital is long term, right? Sundry creditors. So creditor is short term, bills payable short term, bank overdraft, and outstanding expenses will take. Total will come how much? Okay. So what is your current ratio you got? So you got 1,30,000 divided by 65,000. That is 2:1. So till here, any doubt? Till here, any doubt?
No, sir.
Okay. Next, you will see that one more ratio they have asked called as quick ratio. Means more, means immediately, means better than current ratio. We can, means better than current asset. We can easily convert or quickly we can convert into cash. Okay. So when you are calculating quick ratio, so we have formula called as quick asset divided by quick liabilities. Okay. Quick asset or liquid asset by liquid liabilities, we say. So quick asset means if from current asset you minus prepaid expenses and stock. These two things you minus, you get quick asset. From current asset, what you have to minus? Stock and prepaid expenses. If you are minusing, if you are subtracting, you will get current asset. Similarly, To calculate quick liabilities, from current liabilities, you have to minus bank overdraft. You know what is bank overdraft? Right? You'll be knowing, right? If no means you can tell. You can unmute yourself. I have not muted you. Okay, fine. So current liabilities minus bank overdraft, you can subtract to get quick liabilities. Okay. So here what we'll do? Quick ratio will calculate. So calculate quick asset. Quick asset means what all will take? Investment plus debtors plus cash. So how much it will come?
$79,000.
79,000.
Quick
Okay.
liability, 60,000.
Yes, 79,000 you got. And similar way, quick liability means current liability minus bank overdraft. So what is the bank overdraft? You just minus 5,000, right? So how much it
60,000.
will come?
60,000.
60,000. So total how much we got? 1.32 is to 1. Okay. So we can say it's satisfactory, right? 1.32 is to 1 is satisfactory. It's quite good only. We are able to meet our short-term liquidity or short-term liabilities. Is it clear? Okay. Now, sometimes instead of giving question like this, all the values, they can give you question like this where they say that X Limited has a current ratio of 4.5 is to 1. Okay. And quick ratio is 3 is to 1. Okay. 3 is to 1. They will say that if inventory means stock only. Inventory is 60,000. Okay. Find current asset and current liabilities. If they give any question like this. Okay. If they give any question like this, how we can make use of the formula and find out current asset and current liabilities. So how we are going to solve it? So if you see current ratio, so current ratio, what is our formula? So current ratio, how much I can write? Can I write 4.5? Can I write like this? Okay. So from this, what you can understand that your current asset is 4.5 times of current liabilities, right? And second thing, what you can see that your current ratio and quick ratio, okay, they have given. Okay. So current asset we don't know and we know the stock, right? So between current asset and quick asset, what will be the difference? What is making difference here? Stock, right?
Prepaid.
Correct. So can I say that your stock 60,000 is equal to current asset minus quick asset? Can I say this? Like current asset minus stock is equal to quick asset. So can I bring this stock this side and quick asset this side and say like this? I can say, now you will see that now we can see that if I write like this, current asset by current liability. It means current asset is 4.5 and quick ratio they have given as 3.5, 3:1, right? So it means that your quick asset is 3 times, your current asset is 4.5 times. Can I say that? So this 60,000 will be equal to how many times? 4.5 I can write for current asset, and for quick asset I can write as 1.5. Sorry, 1.5 I'm telling, sorry, 3. So this 60,000 is 1.5 times, right? Is it clear till here? Current ratio, how much they have given? 4.5 by 1, right?
Oh,
It
correct,
means
sir.
that current asset is 4.5 times and current liability is only 1 time, right? Similarly, quick ratio, how much they have given? 3 by 1, right? It means quick asset will be 3 and quick liability will be 1. So that is only I have written. For current asset, I have written 4.5. And for quick asset, I have written as 3. Now it's clear. So we got 1.5 times, right? So now you know unitary method, right? Normally we have studied in our childhood, no? That if one apple cost is 10 rupees. So 10 apple cost will be how much? So what you do? You cross multiply, right? Correct? So similarly, I'm telling if 1.5 is 60,000, 1.5 times value is 60,000. So 4.5 will be how much? What we do? Cross multiply. You remember this? So how much it will come? 4.5 into 60,000 divided by 1.5. So how much it will come? 1,80,000. So 4.5 was what? Current asset, right? So your current asset, how much we got? Okay. Similarly, you can find current liability also. So for current
40,000.
liability, what you are seeing? 1, right? Correct. So if
Divided
1.5 is 60,000, 1.5 is 60,000. So 1 will be how much? 40. So your current liability is 40,000. Similarly, quick asset, if we have to find out, tell me. Quick asset is 3 times, right? So same way, 1.5 is 60,000. So 3 times will be how much? So like that also I can ask the question. Is it clear? Is it clear? So sometimes indirectly also you can get the questions to make it more difficult for you, because all questions can't be very easy. Okay. Then one more small concept you can remember, that is called as working capital, right? So separate chapter is also there for working capital, but here itself in ratio you should remember it, that working capital means current asset minus current liabilities. So what we call as working capital, so the capital which required for day-to-day operations or day-to-day business activities, that is called as working capital. So sometimes they can give working capital, they can give current liability, and they say, can you find current asset? Okay. Or working capital and current asset they'll give and they will say, can you find current liabilities? So this you can remember, working capital is equal to current asset minus current liabilities. Okay. Is it clear? So these two ratios we were having under short-term solvency or liquidity ratios. I hope it's clear, right? Current ratio and quick ratio. Is it clear? Now, what ratio we are having? Next, we have just now we have seen short-term solvency. So now we have long-term solvency. So if we have to meet our long-term obligations, whether we are capable to meet or not, that we can find out. So that is either can be called as capital structure ratio, or called as long-term solvency ratio. So in this, first you are having debt. Debt means, debenture, right? And equity means, equity capital, right? So what is the formula here? Debt means your debenture or loan. Debenture or long-term loan, whatever you are having, that you will take as numerator. Equity means I'm talking about honor, right? Correct? So here instead of equity, I will write full as shareholders fund. Yesterday, you remember I have told that retained earning also is part of equity. Remember, we have done one problem. You remember? General reserve is also part of it. Means we can retain it, right? So retained earning, general reserve, equity, share capital. So these all are part of owners fund, right? So that is the reason we say shareholders fund. Debenture. So only debenture or loan will come as numerator, and down all other funds will come. That is called a shareholders fund. So this is the formula for debt equity ratio. Is it clear? Formula is clear. Second formula we have called as proprietary ratio. Proprietary ratio means shareholders fund divided by total assets. Okay. So if your proprietary ratio is higher, means it shows that you have greater long-term solvency. Okay. So that is what these two formulas we are having for capital structure ratio. Okay. Now let's see one question, one example for this also. I'll just share the question first. You can see I have shared one question. So now in this question, first we have to find out debt equity ratio. Okay. So for debt equity ratio, first what we need in numerator? Debenture or loan, right? Debenture or loan, right? So tell me how much debenture you will take? 1 lakh. That is clear, right? Then debenture divided by shareholders fund. So which all funds are for equity honor? So which funds you will take? Equity capital, preference capital. So apart from debenture or loan, whatever you are seeing are from honors only, right? For honors only, for shareholder only, right? General reserve, profit and loss. So these all are, so except creditors and outstanding, because that is current liability. You will take all other things. Correct? Yes, sure. Current liability also you will take, because that is not long term, that is short term. So apart from that, whatever for shareholders are there, for owners are there, you take everything. Clear? So debenture you will take as 1 lakh. Then what left out? All the things, capital, equity capital 1,50,000, preference capital 50,000. Then general reserve is 70,000, profit and loss 30,000. So total how much it is coming? 3 lakhs, right? So 1:3. Is it clear? Is it clear? Second formula is proprietary ratio. So what is the formula? Shareholders fund. So shareholder fund already we are having. Total asset already in balance sheet it is given. How much total asset? 5 lakhs. So your ratio is 3:5. Is it clear? Yes. In this, one more thing we can add as called as interest coverage ratio. So interest coverage ratio tells that whether the company is or bank is the company is maintaining or making sufficient profit to pay its periodical interest or interest charges or not. That is the reason name called as interest coverage ratio. So whether company is able to pay periodical interest or not. So the formula is earnings before interest and tax divided by your fixed interest charges. Whatever interest charges are there, that you can take it. Okay. So like interest we calculate on what? Do you remember interest we calculate on what I told? Yesterday we did know in capital structure interest. So for what I told interest will be calculated. So same logic here will be applied. So that is called as interest coverage ratio. So this one more example we'll see for this. So this I will not solve, but just I will show you. So this is a direct. You can see here. From the following, calculate interest coverage ratio. So what they have given profit after charging interest on debenture and tax. So they have mentioned after charging, right? So after charging is how much? 25,000, right? So we have to calculate before. So after subtracting is 25. So before how much it will be? We'll add back interest and tax, right? Correct? Profit before interest and tax is 40,000. And what is the interest? 5,000. So 40,000 divided by 5,000. Is it clear? Okay, so normally if we subtract, we call as after. If we add back, we call as before. So that is what we have done. We need profit before interest and tax or earnings before interest and tax. Is it clear, these three formulas? Now, few more formulas are there. No need to worry. Once you practice means it will be easier.